The market decided to have quite a volatile day, considering the Fed did basically nothing. They didn't do anything. They decided not to really change their policy. There was no surprise, yet the market had quite a reaction off of little to nothing, and we're not looking into that too much. We are sticking to our guns, as we have said yesterday, and we are playing the fundamentals, the facts, and reality. And one new fact, one new change in reality, and the one thing that I think Jerome Powell actually did yesterday was acknowledge the potential for non-transitory inflation. I think it's weird how the market's reacting today. Even on CNBC, we saw lots of people come on today and say, "Oh, the Fed has got control of inflation. You know, they're like acknowledging inflation. You know, they've got their hands on the wheel." I'm taking, the opposite side of that. I viewed what happened yesterday as, we are not having our hands on the wheel as much. We don't know what's going to happen. We're going to see what happens, and we've got the tools to deal with it. I got it very much. We're going to see what happens. We don't totally know. We've never been in this environment before. Message from the Fed. And I think I'm not trying to say I'm the knowledgeable crystal ball person who has the answers better than anyone else in the world. Not trying to say I'm that person, but I am saying I'm using some clues and history to guide my decisions and to place my bets, and that has served me well. And I'm not, really listening to the masses and what everyone else says. I'm going to stick to my research and my insights. And there are people like Tom Lee, who I know does research and has insights, who I do listen to. But to everyone else and to the masses, a lot of people said COVID wasn't going to do anything, and look what it did in terms of market performance, right? Anyways, what leads me to how am I positioning, and what convinces me in my research that is the correct positioning? Well, I'm positioned for inflation. I'm expecting inflation to continue. There's a lot of people all of a sudden, today, deciding to piss all over commodities. Like, inflation is just totally going to reverse all of a sudden because the Fed did absolutely nothing. So now it's time to piss on commodities. And I just think that's a ridiculous thing to do. I think inflation's here to stay. I think Powell is inching himself in that direction. And I think it is here to stay. And I've talked about this many times, and I'm going to talk about it again, because this is how I view the situation, how I view the stimulus, and how I view the economy at this point in time. It's very similar to the 1920s and 30s Weimar Republic. And I'm not here to say that we're going to see some massive inflation and get off the dollar. That is too far down the line for me to say. But what I can say is the parallels that happened at the beginning of that situation and that have been happening for the last year plus are very similar. So what happened in the 1920s and 30s Weimar Republic, Germany lost World War I, had to make payments, made the first but couldn't make the second. France and Belgium came in and occupied the factories and the mines. Now here's where it's similar. The German government, in the face of a crisis, said, "Don't go to work, we'll pay your wages." In the United States in 2020, in the face of a crisis, the American government said, "Don't go to work, we'll pay your wages." Okay, wages got paid. Wages are still getting paid. Now there's an employment crisis. Not because there's not enough jobs, but people aren't taking jobs because they're not going to work and they're getting paid. This is very similar to what happened in the 1920s and 30s Weimar Republic, structurally. That led to inflation. It's still going on, but in addition, there's been these massive historic asset purchases, these mortgage loan purchases. There's been additional stimulus money that has come in. That is all fact. Everything I've just said is fact. This is not up for debate. This is not something I believe. I have just shared with you what happened in one period of history, with what happened in the most recent relevant period of history. Now, for my interpretation, I think that there will be some effect from that similar to what happened in the first instance of that. But I don't think it's going to be the same. We're not in hyperinflation. It's not like all productivity stopped. When the factories and mines were occupied, all productivity stopped. Productivity has continued. Yes, it's been depressed. Last year, we obviously didn't have the same kind of output. We are producing less cars. But there's still productivity going on, so I don't think hyperinflation in the instance of just continued printing of money and no productivity to compensate for it, I think that's off the table. But in the face of some inflation, which I think is going to happen, so a moderated version of what happened in the 1920s and 30s Weimar Republic, I think that's going to happen. So I'm positioned considering that as a possible reality. And I think considering that as a possible reality, the stocks you would pick in that environment have and are, aren't, it's not like I'm taking darts at the board and I'm taking a big risk by buying those stocks. I'm actually buying stocks that even without that possible tailwind would do well. For example, energy. Energy is highly correlated to inflation. I know we're seeing an opposite move today on the dollar. I think that is a short-term move because I think by the Fed not doing anything, the dollar continues to weaken slightly. And I think it's a short-term move, and energy and gold and all that stuff will continue to rally in the long term. But energy is very high right now, like very, very high. And it's at these levels without the United States economy, without the European economy, and very importantly, especially without the Indian economy, which is the third largest consumer of energy, offline. So when those economies come back online, I think it's reasonable to assume energy stays at these levels or rises. And if you listen to any of the proper, in-depth, experienced energy analysts, they will all tell you the same thing. At the current price of energy, energy stocks should be higher. So I'm listening to them on that, putting my trust in that analysis and, doing some math and comparing of energy prices to stock prices. Factor in cost-cutting measures and possible dividend raises according to Bank of America out of Exxon. That would be fantastic. Throwing in my, transformative tech, 22-year-old philosophy and looking at Exxon and Schlumberger focusing, probably being the leaders in renewables behind Tesla, stocks look pretty damn good. Sticking with that. In addition, back to the Weimar Republic, the stuff that has done best is the farms. Demand remains pretty steady. Everyone's got to eat. It's like the primary good. It's not a want, it's a need. These farmed products, they produce needs, literally the most important need regardless of the environment. And commodity prices with some inflation will continue to rise. I'm not buying the short-term move. Not buying that. I think people just looking to piss, probably missed the move, and just looking to make a statement. I'm looking to make a statement, but we're battling it out. We're going to see who wins, right? We're going to see who wins. Time will tell. Mosaic and other farms, I'm just going to say farms plus Mosaic produces fertilizer. Fertilizer has lots of commodities in it. Nitrogen. It's a product. It should go up with inflation, but demand should remain the same. So, not considering the valuation or anything else, or assets and liabilities, their cash flow should improve. That's what's happened in the housing market. It's what's happened whenever there's inflation. Margins stay the same, inputs rise, but output, prices rise as well. Cash flow increases. Now, this company, Mosaic, valued less than $13 billion, trading at a less than 13 PE ratio, which is good for the entire market. Not many stocks right now with that dynamic. It's got $19 billion in assets, a little under $10 billion in debt, a net worth essentially of $10 billion, making $500 million to $1 billion per year, 3 to 6 years to hold to break even, considering the assets, with the potential for that to increase, the cash flow to increase, seems like a pretty good bet to me, even without inflation, even if you take out the cash flow increase, everything else. So that, with the 5 to 10x multiplier true growth, Facebook, Amazon, I get Facebook's doing Oculus, I get Amazon's got a whole lot in store. My opinion, not the growth I'm looking to take on. Not the growth I'm looking to take on. I'm looking to get those deft, nimble players. So we'll see what happens. That's how I'm positioned. That's a story. That's how I'm reacting to things. Not reacting. Staying chill. Staying with the plan. Sticking to the script. So until next time, peace out.